Let's start, Siwing.
Say it again?
Let's start. Go ahead. You're
Okay.
live.
Very good. Thank you, everyone, for signing up for this webinar this evening. I appreciate all of you to taking time out of your evening to invest your time and to get educated about the topic we have this evening, which is the 2014 real estate forecast. And I hope all of you have a real nice holiday, and as we reflect back on last year, and I hope most of you have done well with yourself, with your finances, and other areas of your life. And all I can say personally, by the way, this is Siwing Yi from the Yi Real Estate Network, and I really, as we start the new year, 2014, I'm just so blessed to have this opportunity to create my organization to help many of you to invest in real estate and achieve your goals and objectives. And 2014 will be no different. I'm just so excited, and I couldn't wait to get this new year started because I have so much potential and opportunities to present to you folks. For the rest of this year, I'm going to do so many great things, all for the benefit of my members, my investors. And so, you know, as you continue to create your goals, and I just challenge you to create a strong financial plan for yourself, financially for yourself and your family, and take action on your goals. And before you know it, a few years down the road, you will achieve your financial freedom, and to help yourself and your family to live a life of your choosing. So with that said, this webinar is my first event of the year, and I've been looking forward to this. And it's important to start this webinar in a high level to talk about what happened in the past with respect to real estate, and we can discuss on this webinar like I said, some high level information about what we think is going to happen for the rest of this year, the forecast for real estate. I know nobody have a crystal ball, but we feel because of my partner, Mr. Bruce Bowen, and his company, Silverstream Financial Advisors, the reason why I invited him and his company to present this 2014 real estate forecast topic is because his team, Steve Saunders and Bruce Bowen and several others, principals of this organization, which I've been working with in the last 2 years, and because they have vast experience in real estate for several decades. So if anybody who's qualified to discuss the 2014 real estate forecast, suffice to say, Silverstream Advisors are the perfect organization to present this. And I couldn't be happier because they, again, they put a lot of time and effort in this particular presentation, and so you all can benefit and hopefully by the end of this webinar, and you could really get motivated, get serious, take action, and commit to your goals, and hopefully I'm here to help you as you're my member. It's going to help you challenge yourself to take action so you can reach your goals. So without further ado, the presenter this evening will be Mr. Bruce Bowen of Silverstream Advisors. So take it away, Bruce.
Well, thank you, Siwing, and good evening, everybody. Thank you so much for taking some time to spend with us this evening. I know it's the dinner hour for most of you, so we're going to try and get through this relatively quickly, but there's a lot of information, especially when we start talking about forecasting. There's a lot of facts and figures, and so to that end, I'm going to ask you to get a pencil and paper and write something and have something to write with. I will cue you throughout our conversation about what I have found to be in the past, having this conversation with others, what are pertinent notes that you might want to take. We're going to start out with a little bit about who we are, who Silverstream is, and then we're going to talk a lot about the market in general. As Siwing said, we're going to start at a 60,000 foot view, and then we're going to drill right down. And at the end of our conversation, we're actually going to be showing you some properties that have got some phenomenal yields and some phenomenal markets that have great returns. So first off, let me welcome you to our call tonight. Let me ask you to get something to write with, and also let me remind you that there will be a question and answer period at the end of the call. Everybody that signed in, in your form that you filled out, you were asked the question, what's your main concern about investing with real estate today? And we're going to address a lot of those questions. So you were kind enough to be very candid with us and share with us what some of your concerns are. And at the end of our seminar or end of our webinar, we will address some of those questions. But we will also have an open Q&A period. So over on the right-hand side of your screen, you'll see a little box, a little dashboard there, and there's a place for questions. You can either type them in as we go, and I'll deal with them as the time is right. Or you can hold off towards the end of the talk and type your questions in then. Let me encourage you to take note of any questions that come to mind as we move through this presentation. All right, so again, thanks for joining us tonight. My name is Bruce Bowen. I am with Silverstream Advisors. Let me tell you a little bit about Silverstream. We were founded in May of 2011, and what we really are is a group of real estate folks, guys and gals. It's that simple. We're a pretty small organization. There is 6 of us really that have hands-on. I've been in the business over 30 years. I did the math today, guys. I'm 60 years old. I started when I was 18, so I'll let you do the math. I was a licensed real estate agent by the time I was 18, and I bought my first property at 20, had my first rental at 21. Back when properties, and this was in California, when properties in California were not yet $100,000 for a single-family home. Paid $70,000, $80,000 for a nice big home in the San Fernando Valley was a lot of money. I hate to make myself seem old, but I've been watching this market for a long time. The president of our company, Greg Wood, has extensive experience in real estate development and real estate finance. He owned his own mortgage company for years through the boom and through the bust, has developed properties himself, has financed large commercial projects himself, and is a developer, a builder-developer as well. Eric Dodge comes from the finance and construction side of the business. He actually is our COO, and he's been at the business for 15 years. Eric has got an extensive construction background. He manages the rehab part of our business. Anna Wood, Greg Wood's wife, she's been in the title and escrow and mortgage business for over 16 years on the admin side. She's the gal that keeps all of our papers straight and does an excellent job and is an expert at IRA funding. So for those of you that want to know how to buy real estate through your IRA, Anna has worked with every major IRA custodian in the nation. Steve Saunders is the one who helped Seawing invite you to our program tonight. He's got over 15 years in marketing, internet marketing specifically, and over 5 years in real estate specific internet marketing. Nathan Dodge, Eric's younger brother, gosh, the poor guy's turning 40 this year. I hope I can say that out loud without him getting mad at me. He's got over 14 years experience. He's our analyst. He and Greg kind of get together and crunch the numbers and decide which markets are good and which are bad. A lot of the information you're going to share tonight comes from that that collaboration of my experience of over 3 decades and going through 3 recessions and ups and downs. Nathan's analytical prowess and Greg's experience. Right now, Greg is in the field. Greg goes out and looks at these properties. He's been in 3 different markets during the snowstorm in the Midwest right now, and has looked at some and found some phenomenal markets that we're going to be going into. So that's who we are, and so what is it we do? It's really pretty simple. We identify high-yielding positive cash flow markets. That's where we start, and we look across the nation. We actually look outside of the continental United States, but specifically, our experience is such that we go into each and every market. First, analytically through the stats, and then empirically we actually put feet on the street and go in there. I've done this in 5 different states since I have been in this fix and flip kind of a market since the bubble burst. We buy properties with our own money from institutional, private sellers, and wholesalers, banks, REOs, credit unions, family offices. We buy properties singularly and in bulk. All of our properties have some sense of distress, either a financial distress or mismanaged or bad tenants or rehabs or deferred maintenance. We fix that distress, whatever it might be. We rehab those properties. and create the highest rental return available. We contact and contract with the best property management company in that particular market and have them manage our properties. We secure tenants on a one-year lease on the properties that we then own, and then we sell those turnkey positive cash flow properties to investors like yourselves. That's what we do. Now, it's fix and flip. Now, folks, I've been doing this before there was a TV show about fixing and flipping. My father was a real estate broker developer, and we were fixing and flipping properties in the late 70s, early 80s, before there was a television show that made it popular. So we have a really good general contractor. I've built a lot of these. I've just personally did a rehab myself, my wife and I, just because I think it's fun. Here in Salt Lake City, had two belt on, and was doing the carpentry. I enjoy it. Eric kind of leads the charge within our group, but know that we have some deep historical, empirical experience around this. Now, why do we do it? The question is, why do we do it? Well, we walk our talk, if you will. Actually, we were doing the walk before we ever started doing the talk. Or another way to say it is we eat what we cook. Our primary goal as a company, the six of us, is to have a company portfolio of over 250 properties before the window closes around this opportunity. We're going to talk about timing here in a minute. But I think it's very important that you understand our motives, why we're doing it. We each want to have personal inventories of properties of 10-plus properties apiece, all six of us within the organization. I have properties in 4 different states now, and I have done this in 5 different states. So, I've bought properties I've never seen. So I have done exactly what our investors do. That's why we're doing it. For every 2, 3, 4 properties that we turn over to investors, we're able to buy and keep one. That's why I rent it. And our results speak for themselves. Our investors over the last, almost 3 years now, Silverstream has been an entity. Our investors generate 10 to 20% return, sometimes 20 plus, depending on where, how the deal is structured. Their cost of entry to do business with us is as low as $10,000, can be as high as $80,000, but not much more than that. We are IRA compatible. Most of our investors come to the table with the IRA 401k. This is obviously an asset protected type of experience for you. You own the properties. We're not talking about a REIT or a TIC or any kind of a joint venture sort of scenario at this juncture. Our investors actually end up buying the properties. We believe in real estate ownership. We believe historically, since we've been watching this stuff, since I've been hands-on with it since the 70s, that's where the gain is. That's where the ownership is. Tax advantages are obvious, and if not, we should talk about that offline. I would encourage you to talk to your tax specialist about that. Inflation protected. It's historically, again, since the beginning of time, and I have studied real estate back historically, specifically on the West Coast, back till right after the end of the Second World War, when the first subdivisions were being built in California and Florida. And historically, real estate has always outrun inflation, far and ahead of inflation. And the beauty is, in this particular marketplace, it hasn't been this way forever in real estate. It used to be an appreciation game. It was to roll the dice. You're betting that the market was going up, and thank goodness it did go up. But today's marketplace, because of the readjustment of values, it pays dividends every month. This is a cash flow market. So why now? Well, folks, I'm going to explain to you here in a few minutes why the supply is shrinking. This opportunity, although we have just come out of one of the worst recessions this country has ever seen in any other time or place or any other economy, this would have been a deep, deep, deep depression. If you just look at the numbers around it and the amount of homes that were decimated and the number of folks who were out of work and the number of retirements that were lost and the number of fortunes that were lost, this was a very, very sad experience that we went through as a community, as a group of citizens. And that put a tremendous amount of supply in the marketplace. Well, that supply is getting gobbled up, and I'm going to tell you by who and how and where here in a moment. And prices are increasing. Now, I see a lot of you are from Northern California. Right now, There are parts of Northern California, San Jose, the Bay Area, San Francisco, Santa Cruz, where prices per square foot are higher than they have ever been historically. There are some zip codes in that marketplace in Northern California around the Bay Area that are more expensive than they have ever been at any point in history, price per square foot. And this is after the most devastating real estate crash in the United States history. So prices are on the increase, right? And in some cases, right, real estate prices are lower than they have ever been in years. So we've got a real dichotomy going on. There is a real crazy kind of a marketplace going on right now, and I'm going to dive into specific markets here in a minute. But if you're confused, that's good. I don't blame you. No matter where you go, no matter where you look, if you start talking about real estate across the board, some people are saying it's a boom market all over again. The recession is over, and we're on the rise again. And there are other markets out there, and there are other analysts out there that are saying that we have still got. I've heard that there was 1.4 billion properties still in shadow inventory. So it's a lot of information to try to digest, and we're going to try to take a snapshot at that tonight. So one thing is for sure, for the real estate investor, not the homeowner, for the real estate investor, the yields today are higher than I have seen them, and my studies show back to the 1950s. The ability to buy a property at buy it at $40,000, $50,000, $60,000 that's renting for $700, $800, $900 a month and showing those types of positive cash flows with the type of financing, the entire package that we're seeing today, 20% down, low single-digit interest rates with those types of yields has never been possible. And again, U.S. modern post-war real estate history in the United States. Now, and the reason for that is it's the result of coming out of the perfect storm of disaster that we went through a couple of years ago. What this all means and says is there's a high, very, very high appreciation value. So let's start taking a look at some of the predictions by some of the experts in the marketplace out there. Zillow tells us that number one, U.S. home values will increase by 3% in 2014. Well, folks, I can show you marketplaces across the country that have appreciated, 15 to 18, as much as 20% in some specific zip codes in the United States. But they're saying across the board, taking the devastated neighborhoods of Detroit, if you will, and taking the high-end neighborhoods of San Jose or around the Bay Area, across the board, increase of 3%. Mortgage rates will reach 5% by the end of the year. This is, according to Zillow, again, this is very, very conservative. I can tell you right now that on the West Coast, 5% is the norm. And I'm talking west of the Rockies. I'm not talking just California. I'm talking, the western 9 states. Right now, 5% primary resident mortgage or very close to it, is the norm. My prediction is by the end of 2014, we're going to see upwards of 7% on owner-occupied mortgages into the low double digits for investment properties, right? But taking the conservative approach, which Zillow does, 5% by the end of the year. Number 3, now here's 3 and 4 could be contradictory, but so let's drill down on them. It will be easier for borrowers to get a mortgage in 2014. Yeah, it will be. And the real estate in some circles or from some point of view is a financial experience. It's a financial deal. There's a tremendous amount of energy and money and effort put into the financing of real estate, and that in many cases is even more important than the property itself. It's how you're going to pay for it. So there's a tremendous amount of interest. Banks make money by lending money. They will figure out a solution to a way to lend money to the pent-up demand of home buyers in the marketplace. So they will make it easier to get a mortgage in 2014. However, homeownership rates will fall to the lowest point in nearly 2 decades. Right? So who's borrowing money, right? Who's buying these properties? Even though the banks are making it easier to buy these, to get a mortgage, home ownership, will drop to the lowest point that it has in 2 decades. A very interesting number. Let's take a little deeper look at that. Let's take a look at what the Wall Street Journal has to say. Now, for those of you that are like facts and figures, start taking a few notes here. Home sales volume, the number of homes is about where it was in 1999. This is directly out of the Wall Street Journal, right? But inflation, the prices are about where they were in 2000, 2001. So although the volume, the number of homes that we're selling is about 1999 levels, the prices are ahead of 1999. So the appreciation is outrunning the curve. Here's a very interesting fact. Construction has always been the predominant benchmark when it comes to real estate values. Whenever the marketplace is demanding new product, when used and recycled product, resale product is consumed by the amount of buyers in the marketplace, and there's demand for new product to supply the need, then that's an indicator of a very strong, very growing, very aggressive marketplace. Construction is up. According to the Census Bureau, building permits are double. I'll let you read the paragraph there, but basically they're double what they are now than they were right after the bust. 613,000 up from 337,000. So construction starts and permits have doubled on new home construction. We're talking just homes, we're not talking commercial and industrial, just homes here. Very strong indicator. It's more expensive right now to build a home than it is to buy an existing home. The price per square foot, the replacement value is more expensive to buy or to build than it is to buy. What is that going to do? Number one, there's always a demand for newer homes by the homeowner. The owner occupied, they prefer a newer home, right? So they're going to be willing to pay that more expensive price. What that's going to do, though, this is called drag along appreciation. Drag along appreciation says that the best value in any marketplace is the least expensive home in that marketplace, because the most expensive home in that marketplace is going to drag that value up. So everything that's out there now that's below the cost of replacement value or price per square foot is going to increase in value to match and or par against what it costs to replace that product by building a new home. So that's why, I hope I'm making this clear, and if not, please start writing your questions down. That's why construction starts are so very, very important to us. Those of us that watch the big picture and the regional picture and drill it down to ground level, we like to know exactly how many permits, new home permits, not add-ons, although they're important, not home remodels, although it's relevant, but new construction permits is a very important indicator in every marketplace we go into. Most of today's boom happened in the, this is interesting, Wall Street Journal is calling it the bubble 1.0. Does that mean that there's going to be a bubble 2.0 and a burst 2.0? I think so. It started throughout the burst in the Midwest throughout the last decade, and you know these marketplaces: Florida, Phoenix, Las Vegas, California, Central Valley. Indeed, the 20 hottest marketplaces in 2013, 17 of those are west of the Rockies in California. So where's the most viable, or excuse me, where is the most dangerous places to be? They're in the ones that have the wildest swings. The properties that increase, the marketplaces that increase the most and the quickest are the ones that are going to depreciate and burst the quickest as well. And we're right on the verge. I'm an hour north of Las Vegas, 2 hours north of Las Vegas. We're right on the verge of seeing Vegas go through another bust. Now, a year ago, we were down there buying, a year and a half ago, we were down there buying, fixing, and flipping, because it was just starting to go through the turn. We were actually on the back end of that. Now the demand has completely been satiated. There's no buyers out there. It has been gobbled up by some of the big hedge funds. We're going to talk about that in a minute. And we are about ready to see another value readjustment in Las Vegas. And there are parts of Florida the same way. I've been in the Florida market. I've been in the Phoenix market, Las Vegas market. I did real estate for 30 years up and down the California coast. Folks, when it comes to long-term investment, where the money is really to be made is in the boring marketplaces. Next one, this next paragraph is very interesting. The home ownership rate, the percentage of housing units occupied by their owners, the owner-occ, has fallen from the bubble era high of 69%. Almost 70% of the homes in the United States were occupied by the people that own them. Worldwide, that is phenomenal. The rate of home ownership in the United States is higher than any other country in the world. We need to be very, very proud of that, and that's why the United States is still the best country in the world, and that's why people are dying to get into this country every day, quite frankly. Today, it's down 65%. Now, a 4-point move doesn't mean a lot, but you know what? It's been over 60% since the 50s. Those numbers do not take into consideration the increase in population, right? The folks that have come in from, as this has been a worldwide recession that we've gone through, folks, and it has affected lots and lots of people. And there has been families and lots of foreign wealth has come into this country and to try to take advantage of our real estate. So the fact that the number of homes, although more homes are going to be sold, and we're seeing some very high prices in some very obvious marketplaces, those homes are not being bought by owner-occupied mortgage families, right? So who are buying these homes? Well, in 2012, institutional buyers purchased about 140,000 homes in the U.S. Now, this is empirical census data. These are hard numbers, right, that we can get from folks like RealtyTrack that count everything. I don't have 2013 numbers yet. I just have a really good guess about what 2013 is. But the 140,000 homes that were bought by institutional buyers, that's not a group of guys like us that are turning, we did 120 buys and transactions last year in 2013, 120 buys and buy and sells. We are not even a blip on the institutional radar. Those people on the right, the Blackstone Group, you've heard of them, Carlyle, you've heard of them, Lone Star Funding and Colony, you've heard of these folks. They're buying 1,400 homes a month in some marketplaces, right? So now, 140,000 homes or 3% doesn't sound like a lot, but when you start looking at some specific marketplaces that we were in 2 years ago, marketplaces like Atlanta or in Tampa, that could represent 20 to 25% of all of the transactions in that particular marketplace. So the smart money, if you will, the people that have been at this for a long time, the wealth building community, the people that control billions and billions of dollars are looking at this real estate opportunity that I have been trying to explain to you all night that, this is a once in a historical lifetime opportunity for real estate values to readjust down to where they were back in 1999 in many cases, and prior to that, and still maintain the highest amount of rent. The income has not been affected. The basis has been affected. Big money, smart money sees that, and it's an appreciating asset. Historically, it goes up in value. That's why folks like Blackstone has committed $1 billion worth of homes, $1 billion worth of funds to buy homes just in the Tampa Bay market, 15,000 homes, right? So they've moved us out of markets, quite frankly. We like to stay ahead of them. We like to go into marketplaces that it's not on their radar yet. It's not just about Wall Street Journal. Forbes is telling us that places like San Francisco, Los Angeles, Orange County, down the Inland Empire, Phoenix, Las Vegas, Atlanta, Tampa, Silverstream has been, and I have been in these different marketplaces in the past. These large institutional market or players come in with their billion-dollar checkbooks and chase little guys like me out of the market. They'll come into a place like Tampa when we were in Tampa, or a better one is Atlanta, Georgia. They came into Atlanta, Georgia, and the prices went up almost 20% overnight, and they were willing to pay for it. Memphis is the same way, right? There are many markets like that. So we like to stay in marketplaces that they haven't found yet. Right? Boring markets that historically have not had wild 20% digit inflation, 20% inflation annually, and which means historically they don't fall off 20% either. So if we're looking at this really volatile marketplace and where we're supposed to be and where we're not going to be, I'm going to give you some idea where the smart money is here in a few minutes. We need to also talk about timing. How long is this going to last? Right? Active construction. You see that over on the right-hand side? The blue arrow says replacement cost. Well, this slide comes out of the middle of 2013. Take that little buy bubble and move it a little further up the curve, because we're starting to see new construction come in here. The prices, folks, that we're buying 8, 10, 12, 15 homes a month, sometimes 20 homes a month. We personally, our company portfolio now is over 50 homes that we own, the company owns within our portfolio. We're going to double that, hopefully by the end of the third quarter within our personal, because we know that this window, this opportunity is closing to get these kind of prices. Now, it's still, income producing real estate, single family homes will still make good rental property, right? When when there's a little bit of positive cash flow, when there's 1% of value, when the rent is 1% of the purchase price. If a $750 a month home sells for $75,000, you're still going to have a pretty good value there. That's still going to be, 10, 12% return, especially when you do the taxes and the appreciation and the write-off and the rest of it. But when you can buy that same $750 a month rent for $55,000 or $60,000, now you got a home run. Now, that's where we are right now. We're starting to see new constructions happen in the marketplace. We're starting to see prices going up. What I used to be able to buy when I first started this whole thing at the bottom back in 2009, we were buying and selling tape. You probably have heard that. We're buying 35, 40 homes at a time, sight unseen, buying them for $5,000, $6,000, $7,000 a piece, buying them from the bank. They couldn't get rid of them fast enough. Buying $300,000, $400,000, $500,000 worth of property and just take them off the bank's hands. Those homes have all been, for the most part, have been processed now and have been brought back into the inventory, and they've been culled through. The good rental properties have already risen to the top. It's already started to make a lot of sense. The bad stuff is, that we've also identified the bad markets as a result of that. Smart Money has, and we stayed away from it. So, the punchline of this particular part of the conversation is that, our window is closing. I can tell you that on behalf of the Silverstream Advisors and our 100 years of combined real estate experience, we have a very high level of urgency that we need to get into the markets deeper and broader at the same time. We need to go further into the market, and we need to buy. I do know to follow the smart guys. To wherever smart money is going, that's where I need to go. So, real quickly, let me talk to you about the 3 different ways to make money in the marketplace, and specifically with Silverstream Advisors. Number 1, you can become a financial partner with us. You can become the bank. You can lend the money. We do all the work. We do the heavy lifting. We do the pick and shovel work. You lend the money, and we split it 50-50, and you are secured in a first position on the loan. Pretty simple. You can do this with your IRA. You have high returns, quick in, quick out. You don't get to share in the appreciation of the property, right? That goes to the buy and hold investor. But you do get to pay the bank. This can be a double-digit return for you. This can be 12, 15, in some cases 20%, depending on the property. You can buy and flip. If you have done this before, and if you've got the ability to get in there and do the sweat equity and manage crews and know how to buy material, and this buy and flip thing, it's not for the beginner, it's not for the weak of heart. But if you want to try that, They're great returns. It's an all cash in type of a scenario. It's hands-on. You can 30% minimum return, sometimes 50, sometimes 100% return in the buy and flip scenario if you're in the right marketplace. Tremendous amount of stress, tremendous amount of exposure, lots of risk because it's all cash, all in. You get great returns, however. So if you're an expert at this, and you want to take advantage of it, we will give you, basically sell you our due diligence packages on particular homes. There's more homes out there than we've identified more homes than we can consume, folks. So we're willing to do the work on those homes and give you a complete due diligence package on them. Or the typical scenario is that folks buy and hold. Income motivated, you want the appreciation. This is perfect fit for your retirement. I don't know about y'all, but my retirement was decimated here in the crash a few years ago. I've just bought a home in Columbus, Ohio through my IRA. So I walk my talk, I eat what I cook. These are great returns. The buy and hold scenario is the most common approach for our investors. And so how does that work for you? Well, it's real simple. It's a 10 to 20% yield. Cost of entry can be acquired through your IRA 401k. We make sure that there are tenants in the property. I'm trying to answer all your questions, folks, before you start asking them. We put tenants in the property, and they're on a one-year lease. Many of the leases have 10, 11 months left on them. We make sure the property managers are the best in the marketplaces. You will own 1, 2, 3, 4 properties in that marketplace. We own 50 or 60 in that marketplace, or 10 or 12. So we have lots of leverage with the property manager. And all of our properties are rehabbed and rent ready with a tenant in place before we ever transfer them over to you. That's really how we do the work for you. Now get your pencils ready. I'm going to give you some examples of some properties here. These are what we like to call game changer properties. At 1046 Gears is in Columbus, Ohio. It's a nice property. There's a unique story about this property. This house was hit by lightning a couple of years ago. So consequently, and I don't know if you know about lightning strikes, they burn a clean hole through the roof when they come down. And consequently, there's been a lavish remodel done on the inside of it. This place looks beautiful on the inside. It's got a great rental history. This property can be purchased for $12,800 down using our 20% down financing, which is non-recourse, by the way. I'll address that in a moment. This property, it throws off a 28.13% ROI. Now, folks, I've dealt with hundreds and hundreds of real estate investors over the years. Everybody looks at these deals a little bit differently. We've got a data sheet that talks about, that looks at each of these properties from the 4 financial criteria that most investors use. So if you have some interest, I'm going to give you my contact information. Just drop me an email, and I will send you lots and lots of information, deep information on each of these properties. 1046 Gears is a beautiful property. 930 Oakwood, classic Columbus, Ohio property. Obviously, you're seeing that we're in Columbus. We love Columbus. We think that there's probably another maybe 6 months worth of inventory for us available in Columbus before the big boys come in there. And what we're looking at today, this Oakwood property, 54, that could easily be $65,000, $70,000. Why? Because it generates $750 a month rent, right? And Blackstone and those guys, they don't care. They know that this property is going to be worth $75,000 or $80,000 in the future. That's why they're buying them, right? This property you can buy today for $54,000. It throws off 35% ROI. Again, lots of information. Write that address down, 930 Oakwood. I'm going to give you my email. If you have any questions, you can just drop me a line, and I'll send you the information that it will give you an explanation on how we come to that 34.81. 717 Eureka, a really cute home. This is a family home, 2-bedroom, 2-bath, $10,000 down, will generate 27%. Now, this purchase price is $61,000, completely remodeled, beautiful, fully furnished basement. This has got a garage in the back, which is very unusual for this marketplace. If you have any concerns about Columbus, folks, we've turned, again, over 100 properties in Columbus. We love Columbus. I own properties in Columbus, and I live in Salt Lake City, and I come out of California. Where the property location is important, and what that means is that it doesn't need to be within my zip code for it to make sense. As a matter of fact, the stuff in my zip code doesn't make nearly as much sense as what I'm looking at right here. right? Hildreth, 1348 Hildreth, great home, solid home, great bones. This thing is going to last forever. It's going to stand forever. 3-bedroom, 2-bath, $56,500 is the price, 32% annual ROI. There is a bit of a discount for cash if you want this, if you want to take a look at these properties at cash. Again, folks, I'm just kind of giving you a bit of an idea of what is available out there. We've got other properties we can show you. We've got some duplexes we can show you. We've got some very deep due diligence packages, including pictures, including inspection reports, including scope of work. You can review the leases of the tenants that are on there. You can check out the tenants' qualifications. I mean, we're very, very transparent. We give you everything that we have on these properties that the state of the property was in when we purchased it, what we fixed on the property, how we corrected whatever deficiency might have been in the property, and that property is cash flowing before it's transferred over to any of our investors. So it's really up to you at this point, folks. I would strongly suggest that you don't wait. I mean, we've been spending the last 2-3 weeks of 2013 and the first couple of weeks of this year, we have been spending a lot of time in analytics. We have been looking deeply into what all the experts are doing all across the board and what the numbers are showing and what the bear market is doing, what the builders are doing, what the finance side of the real estate is doing. I can tell you that this window is closing very, very quickly. I'm saying maybe months, 4, 5, 6, 7 months. And this is not a time when we want to, look over our shoulder and say, I wish I shoulda, coulda, woulda. I mean, I've been through 3 other recessions, right? And boy, I tell you, if I knew then what I knew now, I'd have 100 of these things in my portfolio. And so now is a good time to move forward. So let me address a couple of your questions. If you have any questions, now is a good time to write them into the write them in the question box. I'm going to open the floor here for a second and start taking some questions. But these are some of the questions, some of the concerns that you had on your questionnaire when we asked you what were your concerns about buying real estate today. So let me just address some of them. What are the tax implications? Well, I'm going to send that one back to your tax specialist because that is relevant to your own personal tax situation. So I'm not a tax expert, although I do very well on my taxes. I love my Uncle Sam, but I try to pay him as little as I possibly can, and we do pretty well. So I'm going to just push that one back to your tax expert and say and suggest that you should get professional tax advice before you move forward buying any kind of real estate. How to establish and use a self-directed IRA? That is very simple. For those of you that have IRA accounts that are not self-directed, it is a very, very, very simple process. It's like anything else. The first time you go through it, it can be a bit of a challenge, but after that, it can be, it's as simple as writing a check. We have a lot of expertise at Silverstream. There are so many specific issues around that based on what type of IRA do you have. Is there a match from your company, where you are in your retirement, how old you are, when you plan on drawing upon it, that sort of thing. That requires a little one-on-one consultation. I'm tickled pink to have that chat with you and or get you on the phone with Anna, who is far a higher level expert than I am because she processes these deals every week. And we will answer your questions to the best of our ability and lead you in the right direction. Suffice it to say that millions and millions and millions of IRA dollars are being spent on real estate today by thousands and thousands of people. And it is the way to establish your tax-deferred income and to put that IRA money to use that's probably making 1 or 2 or 3%, if that. It's a good way to get it into the 25-30% range, right? How to choose the right market. That's a big one. That question comes up all the time from folks, and what I can tell you is that the right market is probably not the market you're seeing out the windshield of your car. That's what I can tell you. That's one thing I know absolutely for sure, because most of the folks that have the ability to, the discretionary income, the sophistication to be considering a real estate investment, rental income property investment, probably live in a neighborhood that does not make good rental income sense. I know that for a fact. I mean, again, I come out of Orange County, Newport Beach. I'm in Salt Lake City. Salt Lake is one of the most booming markets in the United States today. It doesn't make a lot of sense here. I can't get 25, 30% return with 20% down. I can't buy a house for $50,000 and have it rent for $750, $800 here. It just doesn't. We can't do it in California. Certainly not in Northern California or in the Orange County area. It can't be done. So leave it to the experts. Right? Do your homework. Let the people like Silverstream Advisors that have got decades and decades of experience doing this, and people that walk their talk. People that if there's a number of companies out there like ours, when you're chatting with somebody, ask them how many of these properties do you own. Right? Do you own properties outside of outside of your neighborhood? I own properties in Florida. I've never seen. I own property in Columbus, Ohio. I've never seen. It's just, I've had a number of them I've never seen. Doesn't make any sense. So choosing the right market, do your homework, rely on the experts. It's probably not the market you see at your windshield. Out-of-state management, that takes some clout. The best way to choose management, again, is by getting referrals of people that have their properties being managed by those individuals already. And in our case, when we refer one of our investors over to our property manager, we still have clout with them. Sure, you might have 1 or 2 properties with them, but we have 15 or 20, or in one case, almost 100 properties with one property manager that we've placed. And we are referring that property manager new business every month. We do 8, 10, 12, 15 of these deals a month, folks. And so that property manager is beholden to us. There is no financial reciprocity back and forth. The deal is, as long as they're showing our investors great customer service from property management, we're going to continue to show them new business every month. Consequently, our investors are very, very happy with the property managers that we've referred them. Age of properties in neighborhoods. Well, that can be tricky. If you're the type of investor that says, I would never buy a property for rent that I would never live in, you're going to miss, you're leaving, hundreds and hundreds of dollars on the table, if not thousands of dollars on the table. The age and property of the neighborhoods is something that is economically driven. Now, folks, those of us that are from the West Coast, we think an old home was built in 1960, 1970. That's when the Triangle was built. Up in San Francisco, that's a little different. That community's a little older. Back in the, you can get back into the 40s and 50s, in some cases back in the 30s, you get downtown. The eastern United States was established. They've got neighborhoods that go back into 1920s, 1930s, and these homes have been standing and have been good properties for decades and will continue to stand for decades. So you really need to look at what is the social economic standard for that particular neighborhood. If you're comparing a home that was built in 1935, 1940 in Columbus, Ohio, to a place that was built in 1990, 1980, as would be an old home in Northern California, and trying to compare the two, it's apples and oranges. It just doesn't work. So the age of the property, well, we've got property inspectors that go out and look at every one of our properties before we buy them. We then repair them before we give them to our investors. We give our investors an inspection and scope of work with a complete photo catalog pictures to go along with it, and then you can get your own inspection afterwards. And I can tell you, folks, no matter how experienced you are, I'm a licensed contractor in California. I've built homes, I've built condominiums, I've built senior living homes, I've built shopping malls. These home inspectors find things I'll never see. So even with my experience, or folks that have my level of experience, we hire professional inspectors as well for, it's the best $300 we'd ever spend. So I would highly recommend that you do the same. Now, you can have all of our inspections for free, right? And you could still bring in your own inspector if you like. So the age of the property in the neighborhood, if the deal has legs, if economically it makes sense, if you're seeing a good return, and you get a good lease, and when you look at the application on the lease, you know you're not dealing, with a crack house, right? You're looking at a family where mom and dad are both employed, and the kids are in school, and that sort of thing. Then you have the property inspected. Then you use your best best discretion, and you'll find that what you think is a good property today, or what you think is a bad property today, when you really start to look at it, is a phenomenal moneymaker if you really start to drill down on it. Another bubble in certain markets, absolutely. We talked about that a little bit. Any market that is quickly appreciating is also a market that could very probably quickly depreciate. So you need to watch out for that. Gaps in rental vacancy. That's one of the distresses that we deal with. What about the breakup in the rental income? That's got everything to do with vacancy or with the management. Now, folks, I've been managing property since the mid-'70s, my own personal portfolio. I don't manage tenants anymore. I haven't for decades. I manage the managers, right? There's one thing that you can always control. If you buy the property correctly, now, if you buy it on the 1% rule, if you buy a $750 a month rent for $75,000, you don't have a lot of room. But if you buy a $750 a month rent for $50,000 and you've mortgaged that at 80%, and your mortgage payment is $250 a month, right? You can control the vacancy, right? You don't. It's to have $300 a month positive cash come in, or have potential of $300 a month positive cash come in, and have it sit vacant because you're too proud to bring it down to $225 a month. In other words, lower the rent by $75 a month and get it rented. That doesn't make sense. So I can tell you, Silverstream, we have no vacancies. We adjust our rents. We are right behind the marketplace. We adjust our rents, and our basis is so low in the property, our equity is so high in the property, to where we have all kinds of room to where, so what? It doesn't cash flow at 21, 22% ROI. It cash flows at 19%. At least it's occupied. So any real estate investor worth their salt knows that when they structure the deal, they need to structure the deal going in. You control your cash flow and your profit at the buy, not at the sell. You go into these deals, you buy these deals, you structure these deals on the front end to where you can control the vacancy by controlling the amount of rent that you charge. You drop it $25 a month on Craigslist, and it'll blow your phone up, I promise you. Out-of-pocket costs. It's a fixed number with us. We tell you what it is, and it's never more than that. We've been doing enough of this now. There are never any surprises, right? That can be a challenge. If you're going into a fix and flip scenario, we go into some of these properties, and again, we've got lots of experience, and we've got a lot of good people on the street in Columbus, Ohio. We think the rehab is going to be $6 or $7 grand. Sometimes it turns out to be 15. Sometimes we've got to put a new foundation underneath it. Sometimes we've got to put a roof on it. That's the risk that we take. But you, on the end, as the end user, at the receiver of the turnkey, that's not really a risk for you. Buying out of state, yeah, it takes when it comes to real estate, top of the right-hand side here, buying out of state, I get it. That question comes up a lot from folks like yourself. It takes a certain mentality. It takes the same mentality to buy out of state as it does to invest in stocks, in bonds, in annuities, in life insurance. That's the same, passive type of, when you buy General Motors stock or Microsoft stock, you don't drive by their building. You don't sit in their boardroom. You don't need to go talk to the CEO of that company. It's not the same, right? But then again, you have a piece of paper. You don't really own anything. Right? But some folks have got all of their retirement, all of their nest egg in stocks, right? Well, if you take that same sort of mentality and you have much more empirical information buying real estate, you actually own something when you buy real estate. You have an equity position in it and an ownership position in it the moment you take ownership of it, right? But you need to have kind of that removed, distant, pure investors, non-emotional mentality when it comes to buying properties out of state. The people that can do that are very, very, very successful. Poor credit, we hear that a lot. I get it, folks. After what we've gone through in the last couple of years, last decade or so, there are some really good folks out there, some really good, hard-working citizens that have had their credit decimated. With us, that's no big deal because we have non-recourse loans in place. Basically, we've got private lenders that will lend you money at 80%, at 7% interest, and they won't even take your Social Security number. It's non-recourse. That means that the property stands as collateral, period. Scams, Yeah, we've been doing it for 3 years. There are a lot of folks that come and go doing what we're doing, and you got to be careful. Please be careful. I can send you all kinds of recommendations or testimonials of people that have done business with us for years and years and years and years. Do your work. Qualified tenants, we make our lease applications available to every potential investor. You know exactly who's renting your home. Continuity of rental income, hassle-free management. That with us, you've got clout. If you buy one property and you could buy that one property across town, you are still just one line item on that property manager's books every month. You buy a property with us and you are part of a team. You could be part of 100 different properties, a major piece of that revenue for that property manager. That's going to get them to answer the phone when you call. Property maintenance, all of our properties have been rehabbed. We will give you scope of work and inspection with photos. That if you're not buying your properties through a reputable firm like ours and you're doing all this on your own, all of these questions make perfect sense. There are no answers to them. But again, 30 years of real estate experience, 100 years combined with the company, 120 plus transactions last year. We've kind of been through this. Understand our motive is very selfish, and our goal here is to build our own portfolio. We want what we are selling. We want to own, for every 3 or 4 of these properties that we sell you, we get to buy one and keep it in our own portfolio. We believe in what we're doing. Why? Because we have seen this market come and go over and over again the last 3 recessions, and we missed it at that particular point in time. Folks, I'm sorry if I get so passionate about this. I see there's some questions coming in now. I've tried to do my best to address many of the questions that come in to kind of save us some time. I'm going to go ahead and open up for questions now. Got a few of them in there. Let me see what the questions are. Please write this down. Bruce Bowen, 801-308-8351, 801-308-8351. Drop me a line, Bruce B at slvrstream.com. Bruce B at slvrstream.com, and I'll be happy to send you more information on these properties. No pressure here, folks. We'll, just want to do business with you. All right, we got, boy, this is a big question. Lots and lots of questions here. Okay. Excellent. We have got a gentleman on the call with us tonight that owns 16 single-family homes. Wonderful. Wonderful. Wow. Welcome. Well, I'm honored, sir, that you should join us. I hope that everything that I have said tonight makes sense and rings with you. Looks like you and I are kind of out of the same sandbox. I would love to chat with you one-on-one. Please send over your phone number, and let's just visit. Anybody who owns that many homes, single-family homes in boring Milwaukee, they're all rented. He's owned them for over 20 years. I hope I can share this information. They're all professionally managed. Well, folks, there's proof in the pudding right there. This is a viable idea. What monthly cash flows are available on those examples you showed? All of the properties that I showed are again, we're going to break it down in detail for you. If there was a particular property, Justin, that you're interested in, drop me an email at bruceb@silverstream.com. Those properties I showed you will, let me back up the slides here a little bit. Gears at 20% down is about $300 a month. Positive cash flow, that's after taxes, mortgage payments, that's NOI, net operating income, after your mortgage, after your taxes, after your insurance. That doesn't include vacancy factor reserve or maintenance reserve because these properties have a fresh 1-year lease on them and they have been freshly rehabbed. Oakwood with 20% down is up just under $300 a month, about $280 a month after mortgage service, after debt service. Eureka is a little bit over $300 a month, and Hildreth is also right around 300. They're all coming about $250 on the low side, $325 on the high side after debt service with them. Okay. I hope that answers your question. Now, there's a lot more to it that goes into the ROI. Okay, I've answered that question. Yeah, all of our properties, if this is about chain of title, are all your properties clear, free and clear, no cloud of title? Yes. That is a big one, folks. You'd be surprised as a result of what has happened here and how this inventory comes in the marketplace. A lot of them came in with a contract of sale or a guaranteed deed or a grantor deed or some kind of crazy, chain of title out there. All of our properties have complete and thorough title insurance on them. Although this is West Coast or East Coast, their abstract of title is a little different than our grant deed and our title insurance that we see here. They have a warranty deed as opposed to a grant deed east of the Mississippi. But the punchline of the result is the same, and that is, yes, all of our properties carry full title insurance without any cloud of title whatsoever. And I can tell you that is one of the stresses that we have had to deal with over and over again to get these properties clean and clear. So when you own them, you own them. Let me see. Please explain non-recourse financing. Okay, let me give that again. And I'm going to give you some interest rates here. Excuse me while I multitask. My age, guys, I just can't multitask as much as I used to. Okay. All right, here is our loan, right? And here's how the non-recourse works. First and foremost, non-recourse is a term that was generated by the IRS that allows independent retirement accounts, IRA accounts, to invest, period, specifically in real estate, a leveraged investment, right? It means that the borrower, who really is the IRA company, it's not really you. You're the beneficiary of it, but the borrower is really the IRA company, not really you in an IRA scenario. So non-recourse means that if something goes wrong with the property or the loan, if it defaults in any way, shape, or form, that there is no recourse back on the borrowing individual, the person, the entity in it. All of the recourse, all of the go back goes onto the collateral, which is the property itself. So consequently, we don't even ask for Social Security numbers or credit applications or that sort of thing. Here are the terms of our non-recourse loan. Get your pencils ready. Okay? It's a combined 80%. We'll do 70% loans. 80%. We have a 70% loan to value first deed of trust. Your first loan is 70%. It is paid at a 7% interest rate. So it's 70% loan-to-value ratio, LTV, at a 7% interest rate with a 30-year amortization. So your payments are calculated on a 30-year payoff. So they're down, they're $200 a piece typically, around $200 on the payment on the first, maybe $300, depending on the property. All due in 10. So it's all due in 10. There is a 10-year balloon payment on the first, right? We have 3 different strategies to pay for that balloon payment. So if you're interested, give me a call. We'll talk through that. I know Seawing is an expert at these sorts of things. Your first loan is 70% LTV, paid at 70% interest. Excuse me, 70%. There's a lot of sevens there. 70% LTV, paid at 7% interest, 30-year amortization, all due in 10. And then Silverstream, we carry a 10% second on top of the 70% first. It gives you a total loan to value of 80%. Our 10% second is at 8% interest, fully amortized and paid off with no balloon payment in 5 years. So the second is a 10% loan to value at 8% interest, fully amortized and paid off with no balloon in 5 years. That sits behind a first at 70% loan to value, 7% interest, based on a 30-year amortization table, all due in 10. No loan fees, no docs, no friction, no points, no loan origination, no junk fees. That's it. That is the cheapest money on the marketplace. Take that information, shop non-recourse loans online, and you'll see that that is the best financing out there, period. Right? So, and there's no, it's non-recourse. We don't even need your social security number. Next question we've got coming in, looks like it's from Justin, is what other markets are you looking at other than Columbus? I can tell you that Greg is looking at 4 different markets on this particular trip. And before we take the time and energy and effort to put the president of the company in the field, living out of hotel rooms and paying rental cars and driving around neighborhoods and talking to appraisers and contractors, you know that we've done a lot of homework before we get in the streets, right? So there are some good emerging marketplaces out there, and quite frankly, folks, that is the best kept secret on the marketplace. What makes us good at what we do, quite frankly, you know, if I might brag a bit, what makes us the best at what we do is that we have the ability to identify these marketplaces before the big boys do, because we're lean and mean, and we get in and get out real quick, and you know, we can put this, we've done a lot of them, we know how to do it, we can put the package together, and we're not a battleship, you know, we're a race boat. We can get in and move around quickly. There are some phenomenal emerging markets coming up, and right now we believe that Columbus, and there's a lot of, if you have some questions about Columbus, there's a lot of really good information around Columbus, specifically around the economy there. The University of Ohio, for example, is that puts $3 billion a year into the Columbus economy. It is known as, yeah, that's a lot of money.
Ohio State.
Yeah,
Ohio State University.
It's known as the smartest city over 1 million people in the United States. It's highly educated. Can you spend some time on interest rates before you run out of time? Will you give an idea how much monthly mortgage? Yeah, I think I've done that a little bit. And, you know, we've got about 7 or 8 more questions here, but I am running out of time. So, folks, on behalf of Silverstream Advisors, and I want to thank you very, very much for spending some time with us this evening. My name is Bruce Bowen. I'd love to chat with you. I can't talk sports. I can't talk politics. I can talk real estate. So if you just want to visit around real estate, give me a call. I'd love to chat with you. Let's take advantage of this opportunity. Let's not wait. Let's not come out of this recession. Watch properties appreciate 10, 12, 15% a month. You know, watch. Remember this conversation we had in the first month of 2014, and regret that we didn't make the move. This is a time in the American real estate history that will never repeat itself, folks. There is so much money. There are millions and millions of dollars of gain and equity to be made here in the next couple of months. I really want to encourage you to take a piece of it. Would love to chat with you about it, and we'd love to be a part of it. And with that, I'm going to turn it over to C-Wing, and I want to thank you all for spending some time with us tonight. C-Wing?
Thank you very much, Bruce. Outstanding presentation coming from a man that I respect, Mr. Bruce Bowen, who's been around for a long time. And this 1 hour, I know it's taken us much longer than usual for webinar, but I mean, you really have to respect and value his experience and from Bruce's perspective. Everything he said, I mean, it's just so, it makes sense to me. And, so that's what you get. You know, you're part of my membership of my organization. You get these kind of resources. You will get this kind of tremendous experience of the people that I work with. Now, I need to say, I'm just spend another 5 minutes on my summary and recap of this presentation because it's extremely important. So, Silverstream Advisors, let me tell you, as I stated for my marketing description for this webinar, the product they present to you is very unique. It's not available anywhere in the country that I know of. But the non-recourse loan product that they present is very, very unique. Now, I know many of you on a personal basis. Some of you have been my member for like 6, 7, 8 years. You are on this call. Some of you are brand new, and I met with many of you already. So here's the bottom line. This product in Columbus, Ohio, for example, the few property that was presented tonight, and other property that Silverstream is promoting. What I'm trying to say is, you know, the 20% down payment, $10,000, $12,000, whatever it is. If you have that much down payment, $11,000. Let's say you have cash. That's all you have. Let's say if you have good credit, that's fine. If you have bad credit, if you have foreclosures or bankruptcies or late payments, whatever on your credit history, it does not matter. If your income, if you have a low salary, no income, whatever, you will qualify to buy this particular investment property from Silverstream. So there are two ways to buy. Okay, I want to really emphasize from a high level, from a very basic level. I know Bruce touched on it, but I think it bears repeating from a different perspective, from my perspective. Here's the bottom line. There's two ways you can buy. One way is you have the cash sitting, you have some savings sitting, $11,000, $12,000, $13,000 that qualify you to buy this kind of property at 20% down. Again, this is a no-doc loan, no qualification. They're not going to check your credit report. Your FICO score is irrelevant. They're not going to check your W-2 or lack of income, whatever. They're not going to, no substantiation. Okay? So with cash, if you have the down payment, 11, 12, 13 grand, which is slam dunk, a drop in the bucket, you will qualify. You're just going to get a, like Bruce said, you can get a first and second loan that you know, on your product. You will qualify. You'll be able to get this property. Okay, so that's slam dunk. That's easy. All right. Now, for those of you that have some self-directed IRA, and I put so much education toward my members of my organization about a self-directed IRA. You know, I'm a sticker with education. So if you want to buy this investment property through Silverstream with your self-directed IRA, all you need is whatever the down payment, the 20% down payment, $11,000, $12,000, $13,000, for example. So you buy in the name of the IRA, and then Bruce and his company will similarly put down this first and second mortgage, you know, the non-recourse loan secured by your IRA. Your IRA will qualify for the house, not you. So therefore, so what I'm about to say is non-recourse loan, this is unique. I've been presenting non-recourse lending through the IRA on my other investment property in a back end, for example, using North American Savings Bank, but they require a higher down payment. But Silverstream, their version of the non-recourse loan is very, very different. It's unique. They created this loan product in-house, I believe. But so therefore, the non-recourse loan is that's only the risk. I mean, if you know, God forbid, if you buy this property, if you default on it, they cannot come after you. Like Bruce said, if you buy with cash, you know, you get a regular loan. So they can only come after the property. They cannot come after your personal asset, right? And similarly, if you buy with a self-directed IRA, if you have $11,000, $12,000, $13,000 self-directed IRA, which many of you have, okay, slam dunk, okay. So you can buy with a self-directed IRA. If for whatever reason you default on this property, which is, you know, kind of hard to do, I mean, they can only come after IRA, come after the property. They cannot come after your personal asset. And if you default on this property, once again, I hate to sound a little bit negative, but your credit record is not going to be affected. You know, the foreclosure is not going to be on your record, okay? And the creditor is not going to come after you, because Silverstream, correct me if I'm wrong, Bruce, in case you default on this property, whether through your self-directed IRA or through your regular loan using your regular cash down payment, I mean, they're not going to come after you. They're not going to get a collection agency to go after you. They're not going to put a lien against your personal asset. Nothing like that. It's just going to take the house back. No impact on your credit history. No impact. They're not going to put a foreclosure on your credit record for any small, minute reason that ultimately if you're going to default. Why would you default when this property itself is already positive cash flow, and hopefully, you know, down the road when you own this property long term, the property management can do their job, is a good rental market, you're going to get good tenants, hopefully, right? Consistent long term. There's no reason to default because you have equity built in on this property, you know, is it positive cash flow. So the risk is very minimal, right? So I want you to make this very clear. That's the value add you you have working with Silverstream. No other investment company I'm working with, no other partners I'm working with currently in any market in the country or in the past 10 years that I've been in business that I've seen such a unique product as presented by Silverstream. Anybody can qualify. All you need is down payment, pure cash, or self-directed IRA. There's no limit as how many property you can purchase. I mean, it's just mind-boggling, you know. So I'm very appreciative. You know, Silverstream is so creative, so unique, you know, in this investment world, and for me to associate with this company, which I have a good track record in the past with, and some of my advisors, investors already purchased through Silverstream recently, just so you know. All right, so hate to be so, I mean, take you so long. I know it's already 7:46. Some of them are already logged out. I understand, but this webinar hopefully will be recorded, right? And in a few days, hopefully, when I'm going to provide you a webinar recorded replay, so you can listen to the presentation, digest this information some more, and if this product makes sense to you, whether you have good credit, bad credit, no credit, and many of you are in this situation. You know, let's be honest, you can do it. You can do this, right? Other products I've been presenting all these years in my organization typically require very good credit, right? You need 20 to 25% down, perfect credit, very high income to qualify for investor financing. You know that, right? For those of you who have a self-directed IRA on other non-recourse lender out there in the country, you need about 40%, 50% down with the self-directed IRA to qualify to buy a property, right? But in this case, only 20% down. Okay. So once again, I hate to be I'm going way over time, but it's something that I have to get this out there. I got to say what I have to say. So with that in mind, Bruce, are you still with me?
I'm still here, Siwing. And
So,
just so you know, folks, just to add on to what he's saying, and then we're going to let you go. We're going to say goodnight. Not one of these non-recourse loans that we have ever placed has ever defaulted. Not one. None of them have ever gone back. Just so you know. So there's no, you know, if the property's making $750 a month cash flow and your total mortgage payment is $300, the investor will work to hang on to that property.
great.
And with that, I think we should say goodnight, Siwing.
Yeah, it's so sorry for this long-winded webinar because you know, because we have so much to say, not enough time. And thank you, and you guys. We got so many people sign up for this webinar. I'm so glad. Without further ado, thank you for attending. You can contact me. All of you know my name, my phone number, my email address. I communicate with you guys so often anyway. I guide you along one-on-one. You know me. I'm very high level. I provide tremendous guidance to my members. I do one-on-one coaching. That's why you guys are so motivated. You guys are so educational because you know, I give you so much education, tools, and resources, and great partnership I have in other markets such as Silverstream Advisors and Bruce Bowen and his great team. So without further ado, thank you for attending. Good night, and contact me, contact Bruce. Bruce and I will help you. If you want to contact us, we can help you identify your financial goals and objectives, look at your financial profile, then we can encourage you to take action and get wealthy and achieve your goals using Silverstream's unique product acquisition strategies. Okay, thank you so much, Bruce. Great presentation, Bruce Bowen. Really appreciate you spending time. And everyone else, good night, good luck, and talk to you soon. This is Siwing Yi, Real Estate Network. Good evening. Thank you. Good night.
Good night, folks.